You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
Welcome back to Options Insider Radio, the interview program here on the old network where we welcome on guests from throughout the world of options and derivatives and proceed to pick their brains for the benefit of you, the listener. My name is Mark Longo from theoptionsinsider.com, and if I sound a little bit different, it's because we're coming at you not from our studio in Chicago, no, but from our makeshift on-the-go studio here in usually scenic and sunny Florida. Not so much today here for the Options Industry Conference 2019. We have a great array of guests lined up for you. Hopefully you're enjoying all the great content we're bringing to you throughout the week, including our next guest, man who needs no introduction. I'm going to do it anyway, though. He is Thomas Peterffy, the CEO, founder, and chairman of Interactive Brokers. Thomas, welcome back to the network. It has been too long.
Thank you so much. I understand I've been with you 2 years ago and haven't seen you since.
It's been a while, yes, and we did it remotely, so technically we didn't see each other the last time. But now we're in the same room, so we get to see each other face-to-face, Thomas, which is fun, to say the least.
Which is a wonderful opportunity to say hello face-to-face.
Exactly,
right.
Exactly. Well, Thomas, let's kick things off. You made some big news recently announcing that you're going to be stepping down in Q3 as CEO of Interactive Brokers. Obviously, it must have been a difficult decision for you. You've had I think, nearly 4-decade career now with IB and in the option space. So walk us through that a little bit. What prompted you to come to that decision this year?
42 years.
42.
I started the company 42 years ago. I'll be 75 in about 3 months. And I think that I still hang in there, but I'm not as good as I used to be. So some younger blood will serve you better, I think.
They say 75 is the new 50, right? Isn't that the old saying? I just made it up, maybe. So how about let's go with that?
Yeah, you probably did.
75 is the new 50. But you will remain on as chairman, correct?
I will remain on as chairman, and since I still own 75% of the company, I can't really leave.
Yes, exactly. And since we're here at an industry conference and there's a lot of talking about the industry and looking back on the industry, let's do that. Let's look back a little bit on your 42. It's amazing to say out loud. 42-year career here in the options market. What really stands out for you as some of the highlights during that time?
Well, the very first highlight was actually 50 years ago when in a new job, my boss told me that, look, people are trading these puts and calls. And he explained to me what they were. And he said, but nobody knows how to value them. And he said, well, if you could figure out a way to value them, maybe we could make some money. And then we forgot about the conversation, but I did not. So I kept on thinking about it, and I had a little computer, and I'd done certain simulations, and eventually I came up with a formula that seemed to work. And but then nothing happened. Then in 1973, the CBOE opened, the first options exchange in the United States, and simultaneously an over-the-counter firm by the name of Goldstein and Samuelson started to sell gold and silver options. And they had big investor meetings in large hotels, in the ballrooms, and they would invite people and they would start telling them about the options they were selling. They explained what a put and a call option were, and how all the people who bought these options were making a lot of money. So I put my hand up and I said, so if all these people you're selling these options to make a lot of money, where do you get the money to pay them? And they said, well, don't worry, because we also make, the people who sell the options also make a lot of money. And I said, well, that's very interesting. So why don't you just set up 2 offices, one uptown, one downtown, and the 2 offices sell options to each other and they will both make a lot of money and you won't have to pay for these large gatherings in these big hotel rooms. And they said to me, well, you're confusing the audience. You don't understand this. Why don't you just sit down? But I went back to my office, and the next day I told my boss about this, and I suggested that we go and sell options and also trade these options based upon the formula that we had at the time. And he agreed, and we started this option business on gold and silver. And we were doing quite well for some time, and then suddenly this company, Goldstein Samuelson, went bankrupt. And our business suddenly dried up because they thought that, well, we were just like them, which we weren't. But that was a very similar situation almost 40 years later when MF Global, right? Your memory is very good. When MF Global went bankrupt, our business suddenly dried up because everybody thought we were just like them, which we were not.
You don't want to be lumped in with MF Global if you can avoid it. Definitely.
Right.
Definitely not. Well, speaking of that, and like the perception of IB out there, obviously you've been with the firm, it's 42 years now. It's hard.
I started it after all.
Yes, of course. And when you think of the legacy of Interactive Brokers and what really makes it stand out, obviously you were very aggressive on price very early, but there's more to it than that. When you think of, the legacy of IB and what really differentiates it, what is it that comes to mind for you?
Well, the first thing is that I started my career on Wall Street as a trader, as a floor trader. And so I was the first one to bring computers to trading and to use computers to trade stocks and options. And so for a long time we were market makers, and becoming a broker was a second thought. It basically happened when after a while, as the markets in Europe and Asia started to go electronic and not yet in the United States, we already had a centralized market-making system that we drove by computers, sending out quotes to our floor brokers, and in Europe and Asia to electronic exchanges. And so we had a global system, and then we thought, well, why don't we just have customer orders going along with our markets, bid-offer markets, and that's how we started Interactive Brokers in '93. And so since the brokerage business was an addendum to the market-making business, we didn't have to build the infrastructure. We already had all the communication systems, the exchange memberships, the back office. So we had very little additional expense. So we could go in with very, very, very low prices. And that's what we did. And since we were more computerized than anybody else, we could be very quick and very efficient. So we didn't. Then the next question was, well, as these exchanges go electronic, what are all my fellow floor traders going to do? And I thought that we will build the brokerage platform for these floor traders who will have to go upstairs when the exchanges go electronic in the U.S. And that's exactly what we did. And so that's why our offering is a financially more sophisticated offering. It's for people who actually make their money trading.
Speaking of making money and some of the challenges that are in the brokerage space, we've seen a wave of new entrants into the space going beyond discounted brokerage, right? Going all the way to free. We just had one in here today in the studio earlier this afternoon with that same model of just completely eliminating the commissions altogether. What are your thoughts of these entrants who are talking about not charging commissions yet? Of course, on the back end, they are indeed engaging in payment for order flow. What do you think of these new entrants to the space, Thomas?
So we will never do that because commissions is the only way we make money, because we have no other source of income. So, but anybody who believes that they are getting free commission, a commission-free brokerage, is basically, they don't understand how life works. So what happens is that these brokers sell their customers' orders to market makers who trade against these orders. We're the only one that I know of that who does not sell our orders. We seek to find the best price for the customer. And there is a problem with this because as these market makers, these high-frequency traders who purchase these orders, they execute them inside the bid and offer market. But the bid and offer market will widen as fewer and fewer retail orders come to the exchange because it becomes unprofitable for people to send limit orders to the exchange. So as the market widens, the people who buy the orders can now pay more for the brokers, so the brokers will send them even more orders. And sooner or later, there won't be anybody providing liquidity at the exchanges. And that really frightens me because we will soon see big air pockets in the markets, and that's not good.
I'm glad you mentioned that because it's an interesting area. We've been discussing it a lot with various guests here, the plight of market makers. You yourself got out of that business a few years ago. In fact, I believe the last time you were on is right before you sold Timber Hill. And I asked you about your outlook for that business, and you kind of laughed and said, "Oh no, it's a terrible business." And when I heard that, I said, "Okay, this does not bode well for the future of Timber Hill." You have since sold it. It is part of 2 Sigma now. Maybe let's start there. I know that probably was a challenging decision for you. Maybe not.
So it's a terrible business if you do not trade against your own customers' orders, and I think that is morally unacceptable to do. So it's not necessarily terrible for people like 2 Sigma because 2 Sigma buy orders from other brokers and they trade against them. So I think that in this world you have to decide what are you going to do. Are you going to be a broker or are you going to be a market maker? And if you are a broker, are you going to sell your customers' orders or are you going to try to execute them at the best possible price? And that is what we decided to do. So we do not sell our customers' orders. We execute them at the best price. And I think that our customers will be ahead that way. If you go to a broker who doesn't charge a commission because they get enough for the sale of the order to do the business, I think it's hard to track, but on the long run, you certainly will pay more than if you just pay the commission in the form of bad executions.
Yes,
Right.
definitely. You mentioned 2 Sigma. Obviously, that they bought your baby, Timber Hill. You think they're doing a good job with it so far? Are you happy with the way they're handling your creation there?
Well, they are still trying to line up their ducks. They are not quite there yet. So, we sold the firm based on an earn-out, but so far we have seen nothing because they are neither making nor losing money. They think that they are still working on it.
I keep bugging them to come on to tell me about what they're up to. They politely demur there, so I don't think they're right. They're not ready. Well, they're not ready for prime time yet.
Right. They have no customers. They have no reason to come and speak to you.
But, you mentioned, the market making and the challenges of that business. That's obviously a big topic at a conference like this. I've seen people here proposing a variety of different potential solutions to this problem. Strike mitigation seems to be a big one right now. But quite frankly, there aren't a lot of new entrants to the space. It is a challenging space. The existing entrants, the high technology cost, high barriers to entry, all these different things, high risk, regulatory challenges. Let's say it's not the growth area of the space right now, Thomas. I'm curious, you were obviously a pioneer in that space back in the early days. What do you think we as an industry can or should do to really maybe try to foster a new wave of market makers out there? I have market making firms coming in here and actually asking me, where can we find competitors? They want more players in the space, which is rare to see that in any industry, yet they realize they're kind of at a bit of a tipping point there. What do you think we can do to maybe foster more market making firms and liquidity providers to get into the game? Because you're right, the alternative is not good for anyone.
Well, that's a very, very tough question. I do not know if it will ever happen. I think that we have to focus on how to bring customers together to trade with each other so that nobody comes between them and takes out some money between the, so if you're a seller, you will sell lower, and if you're a buyer, you will buy higher. That's not good. If we could get buyers and sellers to meet with each other, that would be better. And unfortunately, we have way too many exchanges, so it's even less likely that a buyer and seller will meet. So I think the best thing that we hope, we started this mid-price orders. So if everybody were to send in their orders at the mid-price rather than at the market, then the buyers or sellers would inevitably meet at the mid-price. And that would be great because the buyer and the seller together wouldn't give up any money between them, right, if they traded with each other. So that has to be the future. And the way that will happen is that more and more customers will focus on the same platform. So, for example, an interactive brokers platform, the more orders we get, the more likely we are to be able to match with a buyer with a seller. And that's our mid-price order. So if you send in a mid-price order, you may not get an execution immediately, but you are guaranteed to trade with somebody else at the mid-price. So no high-frequency trader is coming between the two of you.
No middleman in the middle there.
Right.
Well, you mentioned fragmentation. Since the last time we talked, it's gotten worse. I hate to break it to you, Thomas. We're up to 16 options exchanges now,
right,
which is mind-boggling in and of itself. I know you're not a fan. Do you think we've reached that point, that tipping point, where it's starting to become dangerous to the industry, or is this maybe just the natural playing out of competition in the exchange space right now?
So I think as there are more and more exchanges coming about and the order flow does not concentrate anywhere, I think that these exchanges will become less and less profitable. There will be less and less they will have less and less reason for being, and as a result, sooner or later they will be. If there would be other brokers like us who don't really care to sell the order flow and don't really care to go to the exchanges and trying to find the place where they get the greatest kickback, maybe they will fall by the wayside. So, there is no other solution to this problem than nudging people to come together into one place and trade with each other. That's the only thing I can think of. But how do we get there is difficult. So we're trying to do our share, but those of you who are customers of Fidelity and E-Trade and Ameritrade and Schwab, and if you could just get these people to send all their orders to one place, one place that doesn't pay for the orders just executes them at the best price. That would be the way.
Let's go back a little bit, Thomas. I know when I entered the business, and certainly when you entered the business, the exchanges were a different animal, right? They were a different beast. They were not for profit. They were essentially utilities, right? They were places where orders came together and they were executed, and it was almost a public service. We fast forward now to 2019. They've all become for-profit entities. They have shareholders. They have analysts dogging their every step. I'm curious, just as a thought question, do you think maybe we've lost something there? You think maybe that was a negative change for the industry overall to have the exchanges going from these not-for-profit utilities to these for-profit, effectively technology companies now? Do you think maybe we lost something? I'm saying, Thomas, do you miss the good old days? That's what I'm saying.
I certainly do, but I mostly miss what they've done. What they did in those olden days when they were basically serving as a platform where liquidity came together. And so they provided liquidity. That was their focus. Now their focus is profits. And while profits and competition in most cases is a good thing, in the exchange place where the regulator interferes, that is not a good thing, because the regulator, which is basically the government, provides false incentives, and the natural advantages of competition does not come to prevail in the exchange space at this time. So either government has to get out of this, or the exchanges have to get out of it.
Yeah, it's a big lift in either direction there, Thomas. Is that one of the primary reasons why you decided to move your own listing, the IB listing from NASDAQ to IEX, send a bit of a message?
I moved the listing of our stock, IBKR, to the IEX, because IEX is an exchange that wants to bring buyers and sellers together at the mid price. The likelihood is that you will get a better execution at IEX than at any other exchange. They don't pay for the orders, so that is the fairest exchange there is at the moment, and that's why I relisted our stock at IEX.
Are you happy with IEX so far?
Well, I really was hoping that other people will follow our move, and so far they haven't. And there is not much to say about that. I wouldn't say that at this time I have gotten what I was hoping to get out of it. In other words, our stock is not trading any better now than it used to. It's not trading any worse either. But so I'm still hoping that more and more people will pick up on this idea that it's a fairer exchange than others, and that they will move. And if we can get a critical mass of trading volume there, then you will get better executions.
Yes, and obviously IEX, their big selling point is the speed bump. The last time you and I chatted, you were a proponent of effectively a randomized speed bump for equities and for options. Are you still a proponent of that?
Yes, it would be great if that could happen. So, as you know, high-frequency traders buy most retail orders, and they execute them between the prevailing bid and offer. So they buy your sell orders slightly above the bid, and they sell your buy orders slightly below the offer. And from that difference, they pay the brokers and they pocket some profits. So one of the things that happens is if they buy and buy and buy and buy, then they suddenly find that they are too long. So they also have limit orders that they bought, and then they turn around and sell all those what they bought at the limit. And so at that time they don't make money, but they don't lose that much, because the difference between the limit order and the price at which they buy is minuscule. So holding these limit orders, they can basically buy and sell above and below the limit orders and go back and forth and make some money. And when it goes one way or the other, they get out by hitting or taking the prevailing limit orders. So this, unfortunately, disables people to post limit orders at the exchanges because they now only trade against smart institutional orders, and that is not a profitable activity. And the high-frequency traders, if they don't have enough limit orders on their own, they go and sell or buy these limit orders. So if we could have an exchange if we could have all the exchanges to delay the liquidity removing orders by as much as, say, up to 200 milliseconds, a randomized time, then high-frequency traders and other people who try to hit these limit orders couldn't be that sure that no matter how fast they are, that they will be indeed the first ones to get there. And therefore, there would be less reliance on those limit orders, so they would have less incentive to trade against these market orders, and maybe they would leave the business. And that would then create better liquidity for everybody involved.
Since the last time you were on, I took your proposal, I talked to it at conferences like this to a lot of different heads of various options exchanges. I think to say they were not particularly receptive would be charitable. They weren't enthusiastic about that idea, Thomas. But since then, IEX has been approved. It's come online. You've listed there. So there are speed bumps in the marketplace now. Do you think people are a little bit more receptive to your idea now, or are they still as adamant against it as they were a few years ago?
So an exchange pays for limit orders to come there, and charges those who come with market orders to hit those limit orders. Now, if we told them that those market orders have to be slowed down, they would no longer get paid, and therefore that profit center would fall away. So obviously they are opposed to it, yes.
That goes back to our old conversation about them becoming utilities again.
Right.
Maybe we did lose something in that translation. Like I said, it has been a few years since we've chatted. A lot's happened in the market since then, including, of course, 2018, a tumultuous year for the market in many, many regards. We had the beginning of the year, the resurgence, dramatic resurgence of volatility, VIX-mageddon, Vol-mageddon, call it what you will, in February. We had then the sell-off in October as well. But February was particularly interesting for a lot of our audience. We talk a lot about the volatility space. And I was a little bit alarmed in the immediate aftermath of that when we saw a lot of esoteric products like inverse volatility products, XIV and others. They had clearly reached a huge swath of the population that never should have been trading these things. They had no idea because they were reaching out to us with questions like, you're a grandmother in Iowa, why are you trading an inverse volatility product? You don't know what you're trading. So it was a little bit alarming to me, Thomas. I know you've been out front of this for a while. You had your probability lab. You've tried to educate the trading public for quite a bit on probability and volatility and how these things actually work. Were you alarmed by all that wake of the February volatility VIXocalypse, for lack of a better word, last year? Do you think maybe the industry as a whole did a bit of a poor job in putting enough barriers to entry in front of some of these people who clearly should not have been trading these products? They list like an XIV next to a SPY, next to these other things that are relatively staid and have a long track record. And meanwhile, here's this thing that could almost blow out at any moment. Do you think maybe we dropped the ball there, Thomas, and let that get a little bit too far afield?
So February was the prime example of what I'm worried about when I talk about lack of liquidity in the market. As I said, if the retail orders don't go to the exchanges cannot garner enough limit orders, and there is no liquidity. So we will hit air pockets, and we will hit air pockets like that more and more often going into the future. I just had lunch with the head of the clearing organization, and we both agreed that the margins on the short side of options are too low. So if I can say anything to that will be good for you, please do not sell naked options out of the money.
No more. Half of our audience, Thomas, is out there harvesting the risk premium in puts.
That's right. That's
They're
right.
going to be heartbroken when they hear that.
They are selling out of the money puts, and some very, very smart people also do that. But at least I talked to a person. He has say $10 million, and he will sell as much as no more than $300,000 worth of out of the money puts outstanding at any one time. No more than that. And he knows that his $10 million may be in jeopardy one day. But he thinks that he will collect more $300,000 at a time to make up for the $10 million. But please don't pocket it and think that that's yours. Just keep most of it for a rainy day, because, the air pockets will happen in the markets more and more often. Don't do it.
So if you had your way, you'd see higher margins for put selling and naked in general, right, and try to back people away from that. Even cash secured puts, are you down on those as well?
Yes. Or because of the curvature. Once the market starts falling or rising, for that matter, because it's no longer, in my view, it's no longer just one way that can happen. There could be a melt-up that's equally frightening. So from a point of view, an option seller, it's not a position I would ever want to be in.
It is interesting to see how much academic research and brain power has been devoted in the last few years, Thomas, to the quote-unquote harvesting of the risk premium. It seems like everyone in the last few years has rediscovered selling puts. Like everything old is new again.
I've been in this business for 42 years. I've never went bust, and I was never short options.
And that's the first thing they teach you when you walk, at least when I did, when I walked on the floor of the CBOE, right? Is don't be naked short units.
Right.
Nothing good comes with that.
Right.
And we saw that in February. Firms ignored that to their peril. I hear you just got off a panel with one of our other guests, Blair Hull. Hasn't been on in a while for him either. We'll have to bring him on again soon, too. How was that catching up with him? Any fun surprises or takeaways on that session, Thomas?
Well, we reminisced about the old days, and that was basically it. Not much more to say about that.
There we go. Our listeners, we'll put out the panel on our network for our listeners, and they'll be able to hear it for themselves, all their reminiscings. I'd be remiss, Thomas, if I didn't ask you, in the last couple of years, even in Chicago, which is a very derivatives-centric mecca where we're based, there's been just an explosion of interest in all things crypto, obviously. And, obviously, the rally to 20,000 in Bitcoin and the subsequent sell-off has cooled that a little bit. But I'm curious your thoughts. I think you've said a couple of different things on the crypto space in the last couple of years. Where do you stand on this now? Is crypto, is it an interesting opportunity? Is it a fraud? Where do you stand on the crypto asset class in general?
Well, I find it very hard to make heads or tails of it. I think that if you have some money, you should put in maybe a fraction of 1% into Bitcoin and just put it away and forget about it. Because I don't think that it's ever going to be a real asset, but there is enough chance that it could be. So, if the rest of if the rest of our money goes to hell, if it becomes worthless, maybe the cryptos will be worth something. I would never short it. As a matter of fact, if you're an Interactive Brokers customer and you want to trade Bitcoin futures, we only allow you to trade it from the long side, because on the short side, all of a sudden, it's just like an option. So all of a sudden, it can go to any price, and there is no limit to it.
Let's end on a positive note here, Thomas. Obviously, you're winding down your time as CEO of IB, but there's still a lot you have planned. As you mentioned, you're still going to be chairman. You're still very heavily invested in the firm. So you're still very much involved in our space here, in the option space. Looking ahead, it's often at these conferences, people get a little dire. They get sad that things aren't going well. They get lost in their own minutia. But let's look ahead. What excites you about the future of the options market? Where do you see the opportunities? What are you looking forward to pursuing and doing in the coming years?
So, in the options market, just like about the general economy, there will always be new discoveries, new inventions. If I were not so busy doing what I'm doing, I would do continuous research, looking for the companies that are going to outdo everybody else and try to buy out of the money calls.
Not selling puts. You'd be buying calls.
Not selling anything, buying out of the money calls.
So if you retired down there on your porch in Florida, that's what you'd be doing all day. You'd
That's
be
right.
buying out of the money calls.
Researching and buying out of the money calls on the best stocks.
Nice beverage in hand, a nice calm day with a computer, buying out of the money calls. I like that. That's an interesting image. Well, Thomas, I'm so glad we can get you back on. I'm glad we finally had a chance to do it in person. That was fun. If you ever come through Chicago, I'll have to get you into the studio again because this was a fun chat. I appreciate you doing it. I look forward to seeing how all this unfolds and to enjoy your final few months here as CEO at IB.
Thank you.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.